Welcome to the debate. So, today we're tackling a complex and really critical challenge that many seasoned real estate owners eventually face. We're talking about the successful portfolio that, paradoxically, becomes a kind of structural liability over time.
Hmm.
I mean, these are assets that have performed brilliantly, created immense wealth, but now the owner is dealing with intense concentration risk, management fatigue, real burnout, and maybe most critically, these massive looming tax liabilities if they ever decide to sell.
And the usual tools just don't work anymore. Selling, refinancing, even outsourcing the day-to-day management. They're like Band-Aids. They don't fix those deep systemic vulnerabilities.
Exactly. What started as, a successful investment strategy has matured into what is basically a complex operating business, but it lacks the institutional governance and diversification it needs for long-term durability.
Structures that were perfect for growth but become, well, fragile when the owner's focus shifts from accumulation to preservation.
So the central debate today is about a very specific mechanism designed to address this exact fragility, the asset roll-in. This is where an owner contributes their property portfolio into a larger, pooled investment fund in exchange for units in that fund. The core question is this: is this structural transition a necessary and superior way to mitigate that long-term risk? Or do its trade-offs and very strict eligibility requirements make it a niche solution that's just unsuitable for most owners?
Right.
I'm going to argue that these roll-ins offer really the only mechanism to solve the core structural burdens of a mature portfolio without having to abandon the real estate asset class entirely.
And I will argue that while it's a powerful tool, no doubt, its non-universal nature and the inherent non-negotiable trade-offs, especially giving up control and liquidity, well, they restrict this path to a very, very narrow group of owners and assets. It's an elegant solution, but only for the few who perfectly fit the mold.
Okay, I see why you emphasize that exclusivity, but I think we have to start by correctly diagnosing the problem. I mean, the issue for an owner with decades of unrealized gains, say someone who spent 30 years building a portfolio of multifamily properties, is what the material calls the organic growth problem. The portfolio structure, built piece by piece, is now just fundamentally inflexible.
Right.
Traditional exits just treat the symptoms. If you sell, you trigger a massive tax bill, and then you have the headache of reinvesting what's left. If you refinance, okay, you get leverage, but you get zero diversification. And outsourcing management, well, that only deals with the operations, leaving you still holding all of the concentration risk, the strategic key person risk, and all the estate complexity.
And that key person risk being, of course, the fact that the portfolio's success is totally dependent on the original owner's knowledge and, frankly, their energy. If they get tired or sick, the whole thing is at risk.
Precisely. So the roll-in, I argue, solves this root cause. It achieves what a sale just can't. It transitions the owner from being a direct property title holder who's burdened by all this complexity to a limited partner or unit holder in a diversified, professionally managed platform. This preserves their full equity in real estate, but professionalizes the oversight. The focus shifts entirely from, maximizing short-term returns to long-term wealth preservation and durability. It's a completely different status.
That structural shift is compelling. I fully acknowledge the theoretical benefits of moving from a concentrated portfolio to a diversified, institutionally managed one, but the move you're describing, this quiet exit, it's extraordinarily conditional. I mean, this is a profound structural decision, not some simple relief valve for burnout or a quick trick to defer tax. The critical trade-off is completely unavoidable. Owners must exchange autonomy for diversification. You become a unit holder. You own a piece of the fund, sure, but you lose all direct operational control over the assets you built. Your entire financial future then hinges on the fund's aggregated performance and the competence of its management team.
And that centralized management is the entire point, isn't it?
It is, but let's be very clear about the trade-offs of that management. Crucially, the units you get are inherently illiquid. Institutional funds are designed for long-term compounding. They are explicitly not for people who think they'll need access to that capital in the short term. You have to commit to a long hold, often 7-10 years, maybe more, and it's all governed by a partnership agreement with very limited and, frankly, non-guaranteed ways to get out. This illiquidity requirement immediately excludes anyone whose main goal is, say, liquidity for retirement.
The illiquidity is the price of structural stability. It's a necessary constraint. But let's look at the fiscal efficiency that makes this price worth paying for the right owners. For people locked in by decades of unrealized capital gains that would be what? Eroded by 30 or 40% immediately if they sold. A properly structured roll-in is the only way to preserve the full gross equity for continued investment.
Tell us a bit more about that specific mechanism, because it's highly technical.
Certainly. We're talking about a mechanism that, in jurisdictions like Canada, can use provisions like Section 85 of the Income Tax Act to do a tax-preferred rollover. This essentially lets the owner transfer the property to the fund in exchange for shares without triggering that immediate taxable gain. So 100% of the asset's equity value stays invested, compounding inside the fund instead of being immediately split with the tax authority. For an owner focused on multi-generational succession, this preservation of capital it's a critical goal that, in my view, completely outweighs the loss of day-to-day control.
That tax efficiency argument is powerful, absolutely. However, I think we need to pivot from the dollar signs to the control dynamic. That's the real surrender here. I just don't buy that preserving capital always outweighs the permanent loss of control, especially for entrepreneurs who built their wealth on making nimble, local decisions. Once that property is rolled in, the legal title transfers entirely to the fund. You are no longer the landlord, you're a limited partner. All the big decisions, when did you make your capital work, whether to pursue litigation, when to refinance the entire portfolio, all of that shifts permanently to the fund's general partner.
That's governance, not a surrender. It's the professional governance needed to make sure the assets outlive the owner.
It is an irreversible loss of influence. And let's not gloss over the debt. The treatment of existing mortgages is extremely complex and very high stakes. Whether the fund assumes that debt or it gets repaid or refinanced, any debt relief that benefits the owner can trigger immediate unwanted tax consequences that have to be meticulously modeled by professionals before the deal closes. The complexity just underscores that this is a high-stakes, tax-driven decision. It's not something to be taken lightly.
I agree. The debt modeling is a huge complexity. It is not a simple checklist, but it's a complexity you face once for permanent structural relief. Let's look at the operational efficiencies this professionalization brings. I'd argue the roll-in structure is almost perfectly optimized for certain asset types that suffer the most from individual ownership. Multifamily residential property is a perfect example.
How so?
Well, when you take a collection of independently owned properties and roll them into a fund, like the models we see focused on large-scale real estate in Western Canada, the platform gets immediate scale efficiencies. We're talking about centralized management, better bulk purchasing power, standardized operational systems, and crucially, the pooled structure allows for predictable capital planning. Individual owners, they have lumpy capital expenses, a new roof here, a boiler there. A pooled reserve fund smooths those costs across a much larger base, which stabilizes returns and increases resilience.
I acknowledge those centralized benefits. They're attractive from an operational standpoint, for sure. But focusing on efficiency blinds us to the exclusionary reality of it all. The fund model is intensely selective because its duty is to its investors, not necessarily to the contributing owner's need for an exit. They are only interested in assets they deem institutional quality.
What does that mean practically for an owner thinking about this?
It means meeting incredibly rigorous underwriting standards. It's not just having a clear title. It means properties have to show specific metrics, high stabilization rates, minimum occupancy levels, durable debt service coverage. If an organically grown portfolio has assets with a lot of deferred maintenance, or complex family ownership histories, or properties in, secondary markets that don't fit the fund's mandate, they will simply be rejected. So this path is really reserved for the absolute top tier of assets and owners, often excluding the very people who might need the management relief the most.
Even recognizing that selectivity, for those who do qualify, we have to focus on the structural risks that are eliminated. The payoff from meeting those requirements is immense structural resilience. Platform ownership fundamentally gets rid of single market exposure and concentration risk.
by spreading that owner's equity across dozens of assets in different locations. It protects the wealth from a local economic downturn in a way individual ownership never, ever could.
I agree, diversification is structurally superior. But I have to ask, if the roll-in is too restrictive because of the illiquidity and the asset quality rules, how does an experienced owner get meaningful diversification without triggering that massive tax liability you rightly warned us about?
That's the crux of it, isn't it? And the difficult answer is that there are no perfect frictionless solutions. The owner faces a choice between accepting structural risk, which is staying put, or accepting structural friction, the tax cost of selling. The roll-in is the only path that mitigates both the tax friction and the structural fragility at the same time. It's the necessary evolution for those whose primary goal has become preservation.
But this preservation comes with a shifting of risk. You get rid of specific asset-level risk, the roof leak at 123 Main Street, but you trade it for profound platform-level risk, absolute dependence on the general partner. Your entire outcome is now tied to the fund's aggregated performance, its debt strategy, and the discipline of a single management team. You've just replaced your individual key person risk with an institutional one. And if that fund manager makes poor strategic decisions, you as the unit holder have almost no recourse. You've surrendered your most powerful tool, operational autonomy.
That's a fair caution on platform dependency. But let's consider the simplification of estate planning, which is often the ultimate driver here. Individual property titles create immense complexity for succession, often leading to disputes among heirs or forced unfavorable sales. When the assets are rolled in, the heirs just inherit units in a single professionally managed vehicle. It dramatically simplifies everything and ensures continuity across decades, which is a structural benefit individual ownership simply cannot provide. You're moving from a collection of operating businesses to a simple financial holding.
And while that simplification for the heirs is valuable, it doesn't change the fundamental fact that the underlying risks, market cycles, tenant losses, capital expenditures, they all remain inherent in the asset class. The roll-in doesn't eliminate real estate risk, it just diversifies it and delegates the management of it. The owner has to fully internalize that their investment is now governed by an agreement they can't unilaterally change. They are giving up the optionality of direct ownership.
So in summary, my position is that when structural problems like concentration risk and estate complexity become real constraints on long-term wealth, the roll-in model offers the most deliberate and fiscally conservative path to professionalized, passive real estate exposure. It's the necessary evolution for those who've maximized the utility of direct ownership and whose priorities have shifted to durability and tax-efficient succession.
And I would conclude by reiterating the cautionary framing. A roll-in is not a default exit strategy. It is a tool for structural transition, and it's intended for a very specific purpose: wealth preservation, not liquidity. Owners have to rigorously weigh the value of diversification against the significant and permanent surrender of both operational control and short-term access to their capital. It is an ideal path for the very few whose high-quality assets and long-term goals align perfectly with a fund's mandate, but it is not the universal answer for every experienced owner out there.
The fundamental lesson here, I think, regardless of whether a roll-in is suitable, is that experienced owners must actively model the compounding risks of staying put, of doing nothing, because the status quo is never a neutral option.
Absolutely. And because this transition is irreversible, it requires the surrender of control and has such complex tax implications, consulting qualified, independent tax, legal, and financial advisors is completely non-negotiable before taking a single step down this path.
We want to thank you for engaging in this complex but critical discussion about structural real estate transitions and the delicate balance between control, liquidity, and preservation.